A very good afternoon, everyone. Welcome back to the 21st October weekly market review. We have this weekly market review on Tuesday because we had a long weekend because of the Monday Deepavali holiday. So happy Deepavali to everyone. And of course, let us welcome Gerald. How was your long weekend, Gerald?
Was good. Was a restful long weekend. Got to catch up on a few things, including spending time with my family. So I think more refreshed coming into the new week.
Yes, you definitely look more refreshed today, partly also because of the recovery in the market, I believe. So I think the US market recovered quite well last week. And of course, Monday, last night as well, we saw a 1% jump in most of the indices. And Singapore market also recovered quite a bit today. We are sort of testing the 4,400 points again. And over the weekend, we heard some hot property launches that was like 90 over percent sold out. And of course, my Q number did not make it there also. So I think Gerald will share with us some of the key property stocks to look at this week as well. So over to you, Gerald.
Okay, thanks, Sunny. Okay, just a disclaimer before we start. The sharing today is not customized to your individual investment objectives and risk appetite, and hence should not be taken to be financial advice. Okay, if you find the weekly market review helpful, do give us a review on Google by going to this site or scanning the QR code. If you'd like to join SIAS as a member, you can again scan this QR code or go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. Okay, so for the past week, we saw a rebound in US stocks. So the S&P 500 gained by about 1.7%, now back to the 6,660 levels. And with the gain last night, it is back to above the 6,700 levels once again. The gains were led by tech stocks. We see here Nasdaq up by 2.1%. And then for the STI, because it was catching up on the losses from the US in the previous week, so we saw a decline of 2.2%. Okay, so there were a few positive news that actually helped drive the more positive sentiment. First and foremost, we saw that US President Donald Trump saying that the high tariffs on Chinese goods were not sustainable. So this helped to ease some of the concerns on further trade tensions. We also saw Fed Chairman Jerome Powell making some comments around there being downside risk to employment. So that actually led to increased investor confidence about potential rate cuts. We also saw a decline in the 10-year government bond yield to now below 4%. Okay. Next, we have the start of the earnings season in the US. We saw some of the US banks reporting on a very positive notes. So JP Morgan, Citigroup, Wells Fargo, the key US large banks all beat expectations. Lastly, in the AI space, there is new deal activity. So OpenAI announced a partnership with Broadcom to produce its first in-house AI processors. So that led to continued enthusiasm in the AI sector. So quite a number of different new developments across the macro as well as at the company level. And all of that is helping to boost the sentiment towards the market. Okay, so in Singapore, what we see here is that in terms of the top gainers, we have some of the REITs. So FCT up by 1.7%, CICT up by 1.7%. That is largely due to the fall in the bond yields that we have seen with the increased optimism towards the interest rate cuts. In terms of the worst performers, we have some of the more cyclical stocks like Seatrium, Yangzijiang Shipbuilding, sets coming down. For Seatrium in particular, the share price is still being impacted by the news of order cancellation in the previous week. Okay, what I wanted to share a bit more about today is the Singapore property sector, getting more focus in the past few weeks, with a few new launches that have been very well received, with the take-up exceeding 90% in the first weekend of launch. Okay, so what I wanted to share would be some of the latest data points released by the URA that have come out to help us understand what are the trends in this sector. Okay, so if I were to look at the third quarter numbers based on the flash estimates provided by the URA, we see that the private residential price index was up 1.2% quarter on quarter. And what we see here is that on a across the different subsegments, it is the core central region that is having the largest increase in the price index, up 2.4% quarter on quarter. This followed by the outside of central region, then followed by the rest of central region. Okay. Across the different segments that we see here, the private residential price index gain of 1.2% quarter on quarter has exceeded the HDB resale price index that was up 0.4% quarter on quarter. Okay, so those are some of the key findings that I have from this particular data that was released by the URA. Okay, so this is the trend that we see across blended versus non-landed. Effectively, over the past few years, we have seen a sharp gain across both the landed and non-landed price indices. In fact, in the past few years, some of the non-landed prices have actually gone up fairly significantly, but we see here that the non-landed has caught up as well. Okay, this is the breakdown between the resale for HDB versus the private residential price index. And I shared earlier that the private residential price index gain has exceeded that of the HDB resale price index in the past quarter. Okay, and this is the split across the different regions. I mentioned earlier that the core central region is the area that is now seeing the most significant price gains, exceeding that of the two other regions. Okay, next we take a look at the transaction volumes. So as of the middle of September, we have already seen close to 6,600 units being transacted for the private resi sector. That actually exceeded the 5,000 units that were transacted in the second quarter of the year, and reflecting the pickup in momentum that we have seen over the past few months. Okay, so with that, we have actually seen fairly strong residential volumes in the Singapore market year to date, and exceeding that of 2024. Okay, so what are the expectations in terms of the volume sold for the whole of 2025? I took some estimates provided by Propnex, which is the largest property agency in Singapore. And what we see here is that in terms of the private new sale volumes, they expect the total transaction volumes to be between 8,000 to 9,000 units, exceeding that of the past 3 years. Okay, so that is what is mainly driving the increase in overall market volumes. If you see the private resale volumes, that's expected to stay about flat at 14,000 to 15,000 units, and HDB resale volume at between 27,000 to 28,000 units. Okay, so what is driving this pickup in the residential market? I think this is likely driven by the decline in the interest rates. I shared earlier that that is helping to boost sentiment towards the Singapore REITs, but at the same time, the decline in the borrowing rates have also helped to increase the affordability, as well as help to drive improved transaction volumes. So we see here that in terms of the SORA, which is the benchmark that is often used, it has declined from 3% at the start of the year to now close to 2%. Okay, so what are some of the stocks that are exposed to the property sector? We have quite a number of property developers that are still listed on the SGX. And what we see here, for example, Gokuland trading at 0.5 times price to book, UL trading at 0.6 times price to book. So on average, the sector is still trading at about 0.5 times price to book, given that they have actually come off quite a bit from their previous highs. Okay, so this is the share price of UL. It has recovered fairly strongly since the start of the year, from about $5 per share to now close to $8. And if you were to look at the price to book valuation, I mentioned earlier at about 0.6 times price to book, which is just slightly above the historical average of 0.5 times price to book. Okay, next we have one of the property agencies, Propnex. The share price has done exceedingly well so far this year, up more than 100% year to date. And with that, we see that the PE of Propnex is at about 21 times PE, which is above the historical average of 10 times PE. So while we are seeing increased transaction volumes, we are seeing more enthusiasm towards the property market. We also see that some of this is partly reflected in terms of the valuation of the property developers as well as the property agencies, with the price to book valuation as well as the P ratios of some of these names actually being higher than where it was just about 1 year ago. Okay, so in terms of what to look out for in the coming week, we have the US Consumer Price Index data that is likely to be closely watched before we go into the next Fed meeting and will determine investors' confidence around the upcoming rate cut. We also have the start of the earnings season in Singapore, with a number of REITs reporting, including Mapletree Pan Asia Commercial Trust, as well as Fraser Centrepoint Trust. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Joe, for the interesting sharing on the red hot Singapore property market. There seems to be no reasons that can pull back Singapore property market prices. And over the weekend, I also see some of my property agent friends posting some of the units that they secure for their clients. So to participate in that wave, one of the ways is to look at PropNext, which is one of the biggest property agency in Singapore. So not surprisingly, they have performed so well this year. Okay, looking at the Singapore market, the STI market, so we have been down for the past 2 weeks or so, but this week, starting the shorter trading week due to the Deepavali holiday, we can see that on this Tuesday morning, STI actually jumped by more than 1.3%. So that's a good sign that at least we have bottomed out in the near term, and that the last 2 weeks pullback has already sort of reached a bottom where we saw the STI rebounded near the 50 days moving average, the blue line that you see here, around the 4,312 points now. Okay, so where are the key levels to watch out for the STI? We are still in a certain sort of range that we have determined earlier. The next resistance level would definitely be the year-to-date high that we observed on the 7th of October, the early part of October at 4,474 points. Support level coming in at 50 days moving average. That's without saying, because last Friday we bounced there. But just below this level, you can see that the low on 29 September or the end of September, around the level of 4,300 points, that is also a very good support level with a double top formation having a change in polarity, providing further support as well for the STI at 4,003. Okay, so these are key support level that you need to watch out for. If STI will have a chance to pull back to such level, this is where you would need to keep your heads alert, and then there could be some action that you could need to take over here to get on the bandwagon to ride the uptrend in the STI index towards the end of the year. Looking at the indicators, the MACD seems to have a lower negative reading this Tuesday morning because of the 1.3% jump. So that could indicate that if, let's say, we have a crossover of the MACD turning positive, then definitely the 4,470 points level will come back into play again, and that's about 90 or 100 points upside that investors or traders can play with. On the RSI, we have also seen some bounce on the 50-point neutral mark. So that's a good sign. So that 50-point neutral mark is actually providing support for the STI index, similar to the behavior that we saw in the end of September when STI RSI dropped below the 50-point neutral mark. There seems to be a bounce as well. Okay, so the macro environment still seems positive. The uptrend is still intact. We are still seeing the formation of a higher highs and higher low. That means that the uptrend is still intact. So investors should should always exercise the strategy of buying on dips in such scenario. So look out for dips towards the 50 days moving average at 4,312 points to sort of get in on the STI index again. Next, let's move to the US indices. So we had a very good week last week, as what Gerald shared earlier in the summary, and we also have a very good last overnight trading on Monday. So the Dow Jones index, you can see jump about 1.12% on Monday, and that is like almost most of the half of the gain that we saw last week as well. Okay, so we have pushed up above the 20 days moving average. So definitely the uptrend is intact. Market is very bullish. There are a few reasons that support this narrative. This includes because last week we did heard about some of the regional bank concerns of some of the bad loans that seems to be appearing, and I think that could have triggered some overreaction in the market. And I've seen some of the regional bank like Zion Bank sort of rebound up like about 2% overnight yesterday. So I do not think that the regional bank issues, the bad loans issues, are a systematic issues or crisis. But then definitely those news, that headlines would definitely trigger reaction in the market. That could be opportunities for you to get back in. Okay, so on the Dow Jones index, we are now at 46,706 points. The previous high was at 47,049 points. So that will be the main target that we are looking at. So we have a 50 points headroom. The MACD indicator is slightly negative. So that means that there's still a bit of negative momentum, but that seems to be the MACD line seems to be converging upwards towards the signal line. A crossover could mean that we could see a new all-time high for the Dow Jones index, especially with some of the big earnings that's coming up this week. On the RSI, you can see that we are now at a 59-point reading. That shows that momentum is healthy. So going into a 60-point mark, momentum might accelerate up further. So that is a good sign on the Dow Jones index. We have sort more or less overcame the big red candle on the 10th of October, which was the tariff issues, the tariff tantrum that Trump put out in his social media posts. Okay. Expanding on that topic, let's look at the S&P 500. So that big red candle on 10th of October. The recovery last week and overnight in US is also on top of the regional bank crisis. We also see some kind of a de-escalation in the tone of what Donald Trump is saying. In the latest sharing that he has, he is saying that he is very optimistic of a China trade deal towards the end of this month. So investors take that there will not be any sort of a big tariff, 100% tariff being implemented, because he mentioned that by implementing that tariff, it's a lose-lose situation, and definitely it will just lead to non-existent trade instead of the tariff is just a number. There will not be any trades happening. So investors take it as a good sign that there's a de-escalation in the tone in the tariff situation. Hence the big rebound last night overnight as well on some of the big tech stocks. And Apple was up like a very big percentage, if I remember correctly, it's about 3 or 4%. So that leads the tech sector higher. So broadly on the S&P 500 index, the year-to-date high will be the key resistance level towards 6,764 points, just 10 points away. With the earnings season so far last week with the major banks, it seems that majority of the companies that are reporting these earnings seasons will still be able to exceed the market expectations on the earnings reports. So that means that likely the S&P 500, if this trend continues, which a lot of analysts predict to be, then definitely we will likely see a next all-time high on the S&P 500. And I'm looking at the 6,800 level next, with some of the analysts and fund managers projecting that we will see 7,000 on this S&P 500 index towards end of the year. Okay, key support level, needless to say, you can see this black line and the blue line converging over here. That is the low bound of the Bollinger Band with the 50 days moving average converging, and that gives a lot of support around the level of 6,576 points, which is where the low bound of the Bollinger Band is right now. So MACD, the negative reading have subsided a little bit, so it crossed over above the MACD line, above the signal line, would signal a new uptrend for the S&P 500. So do look out for that confirmation. And with the RSI moving into the 60-point territory, that means that momentum could be building up for the broad index S&P 500. Okay, next, let me move to the tech-heavy Nasdaq Composite Index, which was the biggest winner last week and overnight as well. So, riding on the previous 2 points that I said about the US indices, the regional bank crisis is a non-issue. The de-escalation of trade tariffs, we are also looking at the CPI data that's coming in this Friday, and also towards the end of the month, looking at the CME Fed Watch 2, we are still expecting above 90% probability of a 25 basis point cut coming in at the end of the month, and that means that if the cut happens, it will be great news for growth stocks. So that means AKA also known as the tech stocks. So Nasdaq being the largest winner is no surprise. The next resistance level, the all-time high now stands at 23,119 points. So we are about maybe another 100 points away from that level. So it's quite elevated right now, and investors seems to be buying into the big tech earnings, the magnificent earnings this earnings season. Okay, expecting them to deliver another above expectation performance in the earnings. Key support level to watch, definitely you can see low bound of the Bollinger Band has been very good for the past 2 weeks with the pullback. Every time it reached the low bound of the Bollinger Band, it has always been bouncing back up. So that could be the key level to watch at 22,257 points. The MACD negative reading is also subsiding. So the last week pullback is, I would say, it's a non-issue for now for the tech stocks, and all attention will be on the big tech earnings that's coming up in the next few weeks. Okay, RSI has also gone back up above the 50-point neutral mark, moving into the 60-point territory. That means that momentum is likely going to be good, and then it's going to sort of sustain the uptrend that we have been seeing so far. So you can see most of the US indices, the formation of higher high and higher low is still continuing. Given that even with the regional bank crisis and the tariff escalation, there has not been any formation of a lower low yet. So that means the uptrend is still intact, and we are still going to ride this bull run with the recovery since April in the short term, likely towards the end of the earnings season at least, and we'll continue to update you on the weekly market review. So anything else that we need to look out for, Gerald, for this short trading week?
Okay, so I think it is really the consumer price index data that I shared earlier. Given that we are going into the Fed meeting, that will give us confirmation around whether the Fed is likely to cut interest rates in the upcoming meeting. I will also be looking out for a lot of the REITs that are starting to report this week, because the REITs had a strong run over the past few weeks with the lower interest rates. I think investors will want to see whether the lower interest rates is translating to higher distributions for some of the REITs.
Yes, indeed. So a lot of exciting things to watch, both on the US side for growth traders, and of course on the sort of yield traders on the Singapore side as well on the REITs. So do stay look out for all these developments in the market, and we will continue to update you on our weekly market review. So see you guys next Monday, and have a good trading week ahead. Goodbye.
See you.